ethical. And we have four very interesting panelists joining us today, and I would like to welcome them onto the stage if they could please come and join me. First, I have Dr. Zamir Iqbal. And then Dr. Azmi Omar. And then Cheung. And finally, Rushdi Siddiqui. Please take a seat, gentlemen. Thank you. Well, as I said, welcome to this first panel of the day on the topic of hot money versus patient capital. It's going to be an opportunity for all of us to take a first look of one aspect of where responsible finance may just be able to influence change. Before the speakers have a chance to introduce themselves, I wanted just to share a little bit of research I did before I came to this event. The day before I flew out here, I asked my children what they thought responsible finance meant. My 12-year-old daughter very sensibly said that it was putting some money aside for maybe later in life, she's 12, for maybe a car or a home, and that made sense. However, my 5-year-old son basically said it was putting some money aside so he could save some for buying some more sweets tomorrow at the shop. It raised for me that whilst I appreciate they are young, it highlighted two relevant areas which I think are maybe covered in today's discussion. One is the investors' needs, and then also their time horizons. Now, today we're very honoured to have a panel of four distinguished guests on stage with us who are about to offer some insight and thoughts into this topic, and maybe even some consensus. There'll be an opportunity to ask questions later on also, so please do think if you have any questions you'd like to ask, there will be an opportunity. So first, what I'd like to do is ask each person, we have a mic here, so there's a button actually on the bottom you may need to press when you actually need to speak. But I'd just like to ask each of you just for maybe just 2 or 3 minutes, just to give some initial thoughts, introduce yourself and some initial thoughts around this topic. Doctor.
Bismillah ar-Rahman ar-Rahim. Thank you, Chairman. It's my pleasure to be here, and thanks to Responsible Finance for inviting me. I'm with the World Bank. I'm based in Istanbul, where the World Bank has a global Islamic finance center, which I'm currently heading. I think it's was good to know this morning to listen to very distinguished speakers about the responsible finance. But I think there was one question keep coming back in my mind, thinking that even if you have environment issues, if you have a social sustainability and you have governance, will you still achieve the objective of responsible finance? Will it be that stable? And I think the answer keep coming to me was that probably not, because I think the fundamental issue is still not discussed is that the form of financial contracting. Currently, the conventional finance is based on a debt-based system, which is a risk shifting and risk transfer system. Unless you take care of that, even if you have the ESG and other kind of responsible things, you will not achieve the ultimate objective. And I think that's where the biggest kind of a contribution or biggest paradigm shift of Islamic finance comes, that it takes care of the underlying financial contracting in the economy, moving from finance risk transfer to risk sharing, And that is which takes the ultimate goal of achieving sustainable development.
Thank you. Dr. Azmi, if you could perhaps add some.
Okay, let me introduce myself.
It's just the bottom here, just, yeah, here we go, just down here. There's a button there. Should be on there, there
Let me introduce.
we go. No? Use this one.
Okay, thank you. Okay, thank you very much, Stuart. Let me introduce myself, Your Excellencies, ladies and gentlemen. My name is Azmi Omar. I am from the Islamic Research and Training Institute of the Islamic Development Bank in Jeddah. Zamir comes from Istanbul. I come from Jeddah, although I'm a Malaysian. They're working there for the Okay. Coming back to the question of responsible finance, again, I would echo what Zamir said, is that I think one of the key things that we look at today is the global financial architecture. We have to address two things. One is to look at the global financial architecture. Given the current global financial architecture, even if we introduce responsible finance, would it make any difference? I would say yes, to a certain extent. But more fundamentally, we have to go back to the roots of the how the financial contracting is being done. Unless we bring in more equity base in the financial system, reduce the highly leveraged contracting, what is available in the market now, unless we do that, then we will continue to have high volatility in the market. I think that's the basic thing. So coming back, 2 points. One is the changes in the global financial architecture, that's one. Secondly, apart from that is the financial contracting. Reduce the excessive leverage, and to a certain extent, this is a bit controversial, the fractional reserve banking system, and then introduce more of equity-based financing, then hopefully responsible finance can be successful. I think that's my initial thoughts on that.
Thank you. Thank you very much. I wonder if you could just perhaps give a bit of an introduction as well and some initial thoughts, please. Hold the button, just hold it down a little bit, it should work. We pass this one down, just.
Stuart, I think I'm all set. Thank you.
Yep. Yeah, fantastic, thank you.
Thank you, Stuart. So I'm from State Street Global Advisors. I head up the official institutions group, focusing on central banks and sovereign wealth funds. I guess I'm speaking from more of a commercial proposition as a very large fund manager. We manage about $2 trillion of assets worldwide. Stuart, like your daughter, our job description is to create more suites for both our shareholders, but also for our investors as well. That's our key proposition. So I won't go into that in great detail, but perhaps today we can talk about the commercial aspects of ESG investing, how our clients are responding to ESG, how we as a business organization are also responding to ESG as well. I think the theme about short-term versus long-term is, I think, very well taken. So today, I think we should explore that and see whether ESG actually has some very long-term value that I think represents a good investment philosophy for investors. And I think Dr. Zamir's point about risk sharing, I think that's also very well taken. The idea that our business as fund managers essentially is efficient financial intermediation. We have clients with capital, we have investments that need capital, and the idea is how can we actually share that risk through creating efficient intermediation pathways, particularly for ESG vehicles, to allow that risk to be shared. So thank you.
Thank you very much. Finally, Rushdi, if you could perhaps introduce yourself. Thank you. That's working.
It's working. Thank you. Assalamu alaikum. Thank you, Stuart. Thank you, gentlemen. First, I'd like to say a thank you to Blake. I've known Blake for 10 years. First time I met with him was when I was with Dow Jones, and he started this concept of trying to find a convergence between Islamic finance and SRIs. So I've stayed in touch with him by way of his blogs, and it's really nice to see him being the brainchild behind this undertaking. So Blake, thank you. This area is extremely important. I come from a practitioner's point of view. I'm not smart enough to be an academic and definitely not smart enough to be a fund manager, but from a practitioner's point of view. And the topic is timely in light of the credit crisis 1 and credit crisis 2. When we talk about at the grassroots level on hot money versus patient capital, are we looking at the cause? Are we trying to figure out a cure? Are we going to say it's inevitable and therefore we need to contain it? So it's the 3 C's. That's the first thing. Second thing is I would like to put it in context of where the Muslim world is, because 57 Muslim countries, 29 of the 57 are established emerging markets, 3 are G20 countries. The issue in a number of these Muslim countries is the following. They want to create knowledge-based economies. You cannot create knowledge-based economies with hot money. It has to be patient capital. That's extremely important. So there are policy implications, there are practical implications, there are scholarly implications. With respect to Islamic finance and patient capital, in theory, there is. In practice, there may not be. If we look at the bias towards commodity murabaha, and we see most of the sukuks less than 5 years old, what does that imply? With respect to the OIC countries as a whole, 3 ratios that come to mind for me to try to understand the essence of what's happening in the OIC as a whole. 3 ratios. First, deposit to GDP. Second, market capitalization to GDP. Third, assets under management to GDP. Look where the Muslim world is and look where the developed world is with respect to that. The last point, before I give it back to you, Stuart, is the role of the government as a stakeholder in facilitating the infrastructure to create knowledge-based economies. What can the government do? If we look at the great example of Malaysia, 1983, to where we are today, Malaysia, without a doubt, shadow of a doubt, is not only a thought leader, which is an academic perspective, but from the point of view of a practitioner. Anything to do with Islamic finance has been jump-started, has been sustained, has been damage controlled by the government, led more specifically by Governor Zeti. So thank you. Stuart.
Thank you very much. Now, before we move on to some more of a conversation, we have a poll, I believe. So we have a question coming up, which I presume will go onto the board here. So this is the pre-session question here. So for those of you who've got the app and are able to answer this, we'd like you to have a look at this and perhaps give it a little bit of thought, just a minute, and answer. So it's, can Islamic finance and or responsible finance stabilize capital flows? Obviously, there's 4 options there. And we certainly can, you should be able to see on the screen in front of you there. So if you get people voting, are we getting any votes through here? Just give everyone just a minute just to have a quick think and vote. I think it's a very relevant point. I think one of the questions I wanted to ask the panel just before we see the answer for that was very much about, in reality, what's the difference between hot money on one side and patient capital? I think we can have quite an in-depth discussion around the going forward process, but I think unless we understand that at first, we're not going to be able to really evolve that. So do we have a result coming out? I've got a hand coming up. Here we go, okay. Well, that's promising. It's good to see that both is up there as well. So there seems to be a fairly balance between the two. And as only 4% said neither, that looks kind of fairly positive, I think we'll put it and leave it at that. So I ask you this question. The difference between reality between hot money and patient capital, what actually do we see as that difference? And therefore, what does it mean going forwards once we've understood what the difference between those two are? Do I have any initial offers? Not at all. Do you have some thoughts on that?
I guess, anecdotally, we think of hot money as hedge funds, perhaps, very short-term investors. Long-term investors we often think of as perhaps pension funds or other, or perhaps even central banks are also very patient investors as well. Maybe the ESG dimension to this is it's a frame of mind. If you believe philosophically in ESG, I think you're already in that frame of mind where you're inclined towards thinking about longer term value.
Yes, I agree.
You're already inclined to be a bit more patient, perhaps, than a hedge fund manager trying to mark their positions every quarter. I think also it creates an environment where your stakeholders themselves may also be in a frame of mind where they are allowing you as an asset owner to be a bit more patient. So I think that's the way I would think about hot flows and long-term investing and how ESG fits into that. I think the good news is that post-2008, the hedge fund community, perhaps not as strong a force as they used to be. There's been a huge deleveraging in the banking industry that has made the ability to manufacture short positions at will very, very challenging. And I think that perhaps also has allowed the investment community to move more towards long-term investing as well.
Yes, one would hope that's the answer, yes. I think the whole thing about long-term investing is it is long-term, so it's very much about understanding it.
Maybe on that point, maybe I can offer some evidence to show that that's actually happening.
Please
For example, my own firm's experience is that we manage about 8% of our assets in ESG related investments. Anecdotally, they do tend to be stickier. They do tend to be assets that stay longer. 4 or 5 years ago, that number was probably more like 5%. So we now have about, I guess, around $150 billion, $200 billion now in ESG assets. And those have actually stayed with us quite a long time. So I think anecdotally, Stuart, the evidence suggests that these assets are stickier as well.
Dr. Zamir, you talked about the kind of achieving objectives and the risk sharing around that. Obviously, one perspective about hot money is it's very speculative. And the difference with patient capital is it's not designed more for that long-term objective. How do you see that changing going forward?
Well, I think I can give a reference that recently G20 has been talking about alternative finance. And one thing which you may notice in their last communique last year, they talked about asset-based finance. And actually that was a reference to Islamic finance, indicating that the global financial system needs more asset-based finance rather than plain IOU kind of finance. So I think one thing characteristics of patient finance is, or investment is, that it is linked with the real economy and with an asset. And that again depends on how do you define that, whether you do through a risk sharing or risk transfer, that's another thing. I think there's another dimension which you need to look at this case of hot versus the patient, is that it's a typical asset liability mismatch. If a corporate is trying to finance their long-term growth with the short-term money, of course, it's a classical asset liability mismatch, and which leads to an unstable financial system. And I think that's where the responsible finance comes into play, because that tells you what in English verb kind of a saying is that you need to have your skin in the game. So in that sense, the investor need to have a much long-term view, much more kind of a understanding of the risk they are taking, and they put their skin in the game so that they know what they're getting into, rather than just giving an IOU and expecting that everything will be fine for the short term. So there's short-term versus long-term issue as well, which needs to be addressed.
And Dr. Azmi, you talked earlier about the financial architecture. I mean, obviously, yes, this time in the market, not timing of the market. And you also brought up about the high volatility issue. What can you see could happen to try and evolve that going forward, to try and encourage more patient capital into play?
Okay. The way I'm going to answer this will be looking at, in May in Istanbul, we'll be having the World Humanitarian Summit. Okay, and that's a big event, and we have one session called Islamic Social Finance. Okay, Islamic Social Finance. So what I'm saying is that in order to grow long-term or patient capital, one of the ways we can do through Islamic finance is what we call Islamic social finance, meaning that we need to develop waqf fund or endowment fund, trust fund, sadaqah, zakat, and so on, part of the Islamic social finance. The way we do this is through a couple of ways, and we already have some good examples. Like what Malaysia did, Suku Al-Ihsan is one example of what we call the CSR type of investments. But at the same time, we need to develop this waqf fund, because waqf fund tend to be long-term. It tends to be long-term, and what it can be done, particularly for the humanitarian issues, is to help resolve the refugee problems. If you look at the current situation, the number of refugees that we have now is the second largest after Second World War. The first is Second World War, this is second largest. And if you look in terms of percentage, more than 85% of them are Muslims. So then we will be asking questions. What about Islamic finance, or rather Islamic social finance? Does it have any solutions to this issue? The answer is yes, definitely it should have a solution. And one way is to develop this Islamic social finance. These are long-term patient capital. They will reduce volatility, which means that we need to develop various instruments of this Islamic social finance. One example is, of course, Suku as one, and already we are working, and there's also one Malaysian bank working on the humanitarian Suku. We also have social, what we call humanitarian funds, based on endowment or waqf fund, again, in order to address long-term problems, because we tend to, again, people from the development institution like us, we tend to look at, we are development, so we do not consider transition problems, the refugee problem. Whereas refugees are no longer 1 year or 2 years. They stay in refugee camps for 25 years. So is it transition problem? Is it a long-term problem? So we need to develop solutions to that. So that kind of solutions must have financial instruments, which is long-term, that will help to address this kind of problems. So indirectly, it will have patient capital.
Rushdi, I'd like to bring you to this point. I think you talked earlier about the convergence. I mean, do we see a solution here for that in terms of how we can convert more hot money into patient capital to meet those objectives?
Thank you. There is the academic answer, and then there's what's happening on the ground. In 2006, Dow Jones, we launched an Islamic Sustainability Index that had both positive screens and negative screens. It got 0 licensees. Maybe it was ahead of its time. If we look at the Muslim world as a whole, whether it's Islamic finance in the Muslim world or conventional finance and focus on asset management, how many index funds are out there? We've got close to 900 plus Islamic funds. You can probably count on one hand, a few fingers down, how many index funds are there? Index funds led by Vanguard in the United States are the foundation for buy and hold and grow companies and grow portfolios. I think State Street is extremely involved with that. So that's the second thing. The third thing is the key issue here is you've got this sustainability, you've got Islamic, but where are the underlying companies? If you look at Islamic investing on the capital market side, you look at the Muslim world, 57 countries, 42 stock exchanges in the Muslim world. But if you look at the underlying portfolio of the actively managed funds, which is most of them because of the high fees, it's in the West. So at one level, what you have is the following situation. Sharia compliant investing is an element of Sharia compliant flight, where the money leaves the investors in Dubai and Malaysia, global portfolios, sector-based portfolios, and lands gently in the Googles and the Microsoft. How is that helping with respect to development in the Muslim world? To me, those are more practical issues. We can talk about responsible finance, but bring it down to the grassroots where the man on the street or the woman on the street connects. There's a disconnect today. I've seen this in the 3 careers that I've had so far.
It's a really interesting point, and I was going to come to you on this because I think what we're seeing here is very much behavioural in terms of the investor and how they're kind of working. And there is this kind of disconnect between the investor and the money often being put into the market and understanding why it's there. Perhaps you could give us a little bit of kind of insight around that. That is going to be something that's important.
What do you mean by the disconnect?
Well, in terms of many investors are looking for just purely returns. So one of the issues around hot money is it's short-term, it's hot money because it's hot. It comes in and out of the market very quickly. Patient capital requires somebody to understand what the investment means, what actually it's doing for them, but also, as we heard kind of already from the conversations this morning and the address, the keynote speakers, it's also about understanding actually what it's doing further out there. So we like to see some financial return, but what's the social return as well?
Yeah, so maybe so maybe one way to make that tangible is perhaps to repeat maybe the misconception that sometimes if you just invest in the market, your money is dormant, it's not doing much, it's not creating much of a reform agenda. I think that was your point, right, about the passive as being a rock bed for creating a very long-term investment profile. So it does also, so long-term investing, i.e. investing on, for example, a passive basis can also generate the reform program that you alluded to, Stuart. I just, while you were talking, I just took out some statistics that one of my colleagues provided for me. As with any fund manager, part of our responsibility is stewardship over the companies. So even for our passive strategies, we apply that stewardship just as we do for any other of our active strategies. So we probably had about 636 separate company engagements in 2015. 223 of those were reactive, i.e. some news was flagged to us and we felt compelled to do something about it. 413 were proactive. We looked at certain metrics aligned with stewardship as well as ESG priorities, for example, and we felt the need to engage those companies to find out what they were doing. For example, in the pharmaceutical sector, we identified last year that perhaps bribery and corruption was an important factor to begin to look at. For consumer sectors, we focused on issues like staff remuneration as well as human rights issues as some of the things that we engaged in. So I think that's how we can how we can clear up that disconnect, to actually try to explain to investors that investing in a company, be it active, passive, or any other manner, has certain responsibilities, and those responsibilities are things that any fund manager should really go through, with a very disciplined and organized program, with ESG really at the forefront of that.
Thank you. I mean, there's no doubt about it that people are now seeking more feel-good factor from their investments. I mean, I think people are looking for more of that. But it also comes down to the institutions as well, how they then treat it. I mean, does anybody like to share some thoughts a little bit around maybe that, in terms of where, on an institutional basis, also they're taking greater responsibility to share that out to the investors, to encourage them to invest and hold that for the long term? Dr. Azmi, I mean, whatever we had any thoughts around that?
Well, I think maybe slightly different perspective. I was talking to one of my professors and I asked him, he has been teaching for almost 30, 40 years, and I asked him, what's the difference you see in the students which are coming earlier, 70s, 80s, and now? And I think one thing he mentioned, which is maybe links to what you are saying, he thinks that today's young people or students are more active. They're more kind of activist. They're more aware of the issues, and they more feel themselves to be engaged in the social issues. And I think this is what the trend is happening, that the average person is getting more involved, and that's because of, I think, all this digital revolution which is taking place, that everyone is aware of the issues, everyone takes a position, and then they actively get involved. So there are, the new breed of investors who care about these issues rather than purely on the financial basis.
Yeah.
And I think that's a very kind of a good trend. But I would say at the same time, when you look at Islamic finance, the basic teachings of Islamic finance also make an average Muslim become aware of these issues. But again, that is up to the theory. When we see about what is the state of economy in OIC countries, then things are different. But I think that much more education need to be done, much more financial literacy need to be done, and I think that will mobilize more of new breed of these investors. With the investor's mindset is different. Even today's investor may like to say that, yes, we like Islamic finance, we like this is ethical finance, but as soon as you tell them, okay, you may lose your principal, you lose your capital, they suddenly become, no, we want a scoop which looks like a fixed income security.
That's the same with any investment, isn't it?
That is true, but see, that's what I'm trying to raise, that it's the mindset of the investor is halfway there. They are bought on this ESG and the sustainability and social finance. They have to go one more step to accept that, they need to be a bit more on a, risk-sharing finance.
Rushdi, you wanted to jump in at this point.
Yeah, thank you. If you look at a society, emerging markets more specifically, there are 4 change agents, and they are important stakeholders in what we are discussing today in the next 2 days. The youth, the entrepreneurs, the women, and the SMEs. All of these 4 stakeholders have one common denominator. Do you know what that one common denominator is? It's access to risk capital. Islamic banks, for example, finance tangible stuff like this. They don't finance this, ideas. So when you are basically excluding those change agents because risk capital isn't there, you are losing out on the opportunity to build that knowledge-based economy. So call it patient capital. Patient capital has to have a blueprint, and that blueprint has to address stakeholders, and these are the stakeholders.
Yes. Please.
Yeah, I think so. So I think that's right. I mean, it's the mindset issue. If I were to put it in very crude commercial terms, I would say the market is changing. So Stuart, you quoted your own, your daughter example. Let me quote my teenage daughter example. I remember when I was 18, the first thing I did was to rush out and get a car. I suspect many of you with grey hairs had similar aspirations at that age as well. My daughter, she just didn't care about that. That was not something that motivated her, did not drive her, was not something that really was something that you're eager on. So as Dr. Zamir says, the whole mindset, I think, has shifted. I think the good news, there is a marketplace for these type of concepts. I've mentioned some of the commercial success factors already in terms of the growth of ESG assets that my own firms experience. Another great example of this is recently we listed an exchange-traded fund on the New York Stock Exchange. The ticker symbol is SHE, S-H-E. Now you can imagine what the investment focus was. It was gender diversity. We did this because we did all the market research. We thought there was a great opportunity there and a great way for a certain segment of the market to be able to express their investment views. So I think the mindset is actually shifting. I'm not concerned at all about demand. I think this is actually something that will just grow in popularity.
I suppose the concern there is there's the headline. So you can create headline, you can create something of a focus whereby people are interested and keen to do that, but then it can quickly go off as well. So it doesn't necessarily give the perfect solution, I suppose, but at least it's some way towards trying to get that recognition. Dr. Azmi, you wanted to add something to that?
If I can add further. Although I do agree that, yes, education is very important. People would like to see Islamic finance to be implemented in its wholesome manner, using the risk-sharing contracts. But again, that would depend on the kind of countries that have implemented Islamic finance. In our work in IDB, 56 member countries, and inshallah, in this coming May, there will be another country that will be joining us. It will become 57 countries. But again, in our work, we'll find that countries that have, or on the verge of implementing Islamic finance, to them, risk-sharing would be secondary at that stage. It's just to provide an alternative financing mechanism to its population. So that would be, so we have to look at different segments. We cannot be saying that, yes, overall we need to have this. Yes, we need to have, but in the different segments, different market would have different requirements at the initial stage. And as it goes along, as the market becomes more sophisticated, obviously the demand for risk-sharing contract will come in. And that's what we see. Similarly, in our joint work with World Bank on the SME, we'll see again the demand for risk-sharing, particularly for SMEs, is very great across member countries. On one hand, you see that, yes, SME businessman wants risk-sharing principle, risk-sharing contracts, but at the same time, for an average investors or average depositors, that will come to the last requirement.
Could I
Yes,
just,
please.
I think maybe you want to clarify confusion. I think ultimately Islamic finance is about risk sharing, but again, it's not all risk sharing. Part of it is asset based. So the emerging markets, a new entrant who wants to do, they can safely do asset based finance, which Islamic banks are doing through Murabahas and Ijara and those things. So it's not necessarily everything has to be risk sharing, but either it's asset-based finance or a risk sharing finance. So at early stages of development, a bank will be more reliant on asset-based finance. Nevertheless, both asset-based and risk sharing would be responsible finance.
I think one of the keynote speakers talked about building trust. Do you see the focus on ESG being able to do that? Because I think if trust is implanted, if trust is enabled for the investor, no matter how small or large, that will encourage longer term behavior in terms of understanding the horizons. Do you see that as an opportunity, Rushdi?
Trust is a little bit like love. It's difficult to define at times, to be honest with you. There's trust in terms of principles and bylaws. So at one level, on a piece of paper, it looks good. But then there's the reality, right? You can have laws against insider trading, but are they enforced? I'm using a rhetorical question there. So the point here, trust of whom? Trust of the fund manager, trust of companies, CEOs, board of directors, to follow through what they say when there is a photo op, right? That's extremely important. Do we see that trust translated into returns? See, at the end of the day, what it comes down to is you can have CSR, SRI, ESG, sustainability, all the alphabets that you can possibly think of. But if the returns are not there, in the case of Islamic investing, then people, the man on the street thinks, I'm being penalized for following my faith. Right or wrong, that's the mindset. So the trust has to also translate into returns, because the returns are there. People are going to thump their chest and talk about this. In the United States, the largest Islamic equity fund, Amana Funds, I think Monim is here, and he'll tell us more about this. It's got close to $4 billion of assets under management. There's an income fund and a growth fund. The majority of the investors in those funds are not Muslims, and you have an Islamic fund. Why? Reason why is, one, they're in a fund supermarket. B, more importantly, there's returns. Everyone chases returns. So returns tied to principles gets you traction.
There's no doubt about it. Money is not important until it is important. And at the end of the day, people investing with an objective need to meet that objective. And certainly, from your experience on, if people have poor performance, then the patience goes. Though I like the idea of us perhaps falling in love with ESG as opposed to just trusting it. Maybe that's the way we should go forward to that. So, well, yes, give some thoughts around that, please.
Yeah, I would I would probably rank trust. When you mean trust, I think what you meant was really trust in the type of investments that a person is making is consistent with their values. I think that's the kind of trust that we're talking about. I would say that that level of trust, probably for our investors, is more important than perhaps returns. Don't get me wrong, I think returns actually do look pretty good. As I think George Kell mentioned in his opening address, the numbers suggest that ESG actually drives positive performance. The MSCI Emerging Market ESG Index that you talked about, I think that's also outperformed the broad index as well, at least over the shorter term. So returns are actually pretty good, but I think their primary motivation is really about, is what I'm investing in consistent with my principles? And this is where things, some of the examples I mentioned before about human rights perhaps, how you deal with the employees within the company, corruption, anti-bribery, these are kind of things that I think investors really look at when they invest in ESG. Obviously, there are other issues as well, like environmental issues. That's also important for investors, and I think that's also part of the trust equation that gets built in before an investor invests into that particular segment of the market.
I suppose one of the issues around that is getting access to that information, without a doubt. I mean, moving kind of away from the individual investor, and shortly I would like to come to the floor to maybe ask some questions. But just before we do that, one of the things that potentially is highlighted around this is that if there was more patient capital deployed as opposed to hot money, could that, I ask you, actually reduce market volatility? Could we see a kind of greater stability with companies' investments and also how investors then act? Any initial thoughts on that, please? Rushdi, please, thank you.
You may want to do that, but let's look at the landscape first and foremost. If we look at, again, the Muslim world, because that's what one of the emphasis is, you look at the retail investor proportion in the stock market. As in Saudi Arabia, and I'm using statistics that may be a bit dated, there's more retail investors, meaning they ride up and down stocks all day. You can introduce ETFs in those markets, but for whatever reason, they don't capture the imagination or get traction, which is befuddling, to be honest with you. So that's the first thing. The second thing is, where are you going to go with this? See, at the end of the day, you can have stage one, this is your blueprint, but what's the end goal? Have we basically said, here's the goalpost, and if we get there, we'll be a knowledge-based economy, high-income economy, diversified away from commodities, we'll have financial inclusion, and how is that quantified to the bottom line, which is a rising per capita income? So you can't really speak about things in isolation. There's this multiplier linkage effect, extremely important. Otherwise, it's just an academic exercise in an ivory tower.
Well, I mean, I beg to differ a little bit. I think it depends on the risk appetite of the investors. You have investors which are long-term, which are pension funds, institutional investors, ancient sovereign wealth funds are those. I think they can take a long-term view, they have more risk appetite. But if you're talking about a money market fund, or if you're talking about someone who needs the payment system in the banking, of course they won't have a patience and they want liquidity. So I think there's a balance between the liquidity requirement and the long-term and your risk appetite. If you have a high risk appetite, then you'll go for a long-term, or for that matter, this all issues come of the trust comes back. Because if you have a trust, you will be willing to take a long-term view. If you don't trust the market, this is a purely well-known thing in the markets that as long as people lose or the investor lose trust, this short-termism comes back, and they always try to go back to safety and to the high-quality assets. But as soon as the trust is restored, they're willing to go long-term. So I think this is a balance between your liquidity needs and your risk appetite.
But there's no doubt about it that a lot of the market volatility comes around from speculation as opposed to what the underlying investment is doing. So often we see this movement in markets that are difficult to judge on the basis of perhaps what the corporate returns are. So how does that then translate across to that?
No, I think that's what we were saying, that maybe where you have a risk appetite, which is a bit long-term, a bit more, and you can compromise on liquidity. So, but if you want liquidity and if you want kind of a short, maybe in and out of the market and quick returns, then probably you'll have the issue of keeping that, keeping volatility in the market. But I think the main one of the issue is that how do you incentivize the investor to avoid speculation and stay for the long term? And that depends on your risk appetite.
Okay, thank you. Please.
Coming back to what Rushdi is saying, you see, if you look in the Middle East, particularly in the GCC countries, you tend to find more retail investors as opposed to institutional investors. That's one, because one, for example, is they wouldn't have these provident funds. Whatever salaries that you get, it's all belong to you. There is no such thing as something for your safekeeping in the future. So essentially, most of the investors in the stock market there tend to be retail investors. That's why you tend to find high volatility. So how to resolve this? You need to have institutional funds, mutual funds, more this in a way would reduce volatility because you would have more institutions looking for long-term approach. But nevertheless, we do have anecdotal evidence to see that for individual businessmen, they are more long-term in nature. So you see that's a difference. Individual businessmen, they tend to be long-term, look at how they have a long-haul approach in order to develop their business. But you don't see this in the context of retail investors. So there's a big gap between the two.
Okay, thank you. Okay, I'd like to offer this opportunity for any maybe questions from the floor. Is there a roaming mic of some sort? Oh, yes. Oh, yes, big point. Right, okay. If you could keep your questions short, please. Obviously, I would like the panelists to have the opportunity to answer them and share their thoughts around. Do we have any questions in the room at all? It's always the first panel. I'm not so sure about what questions. Oh, we have a question down here. Yeah, use the mic there, yes.
Hello, Assalamualaikum. My name is Sohaimi, a student of Islamic finance. Now, I have a more fundamental question, very interesting topic. And my fundamental questions will be, what constitutes hot money? And also, what is meant by patient capital? Now, the way I look at it, I'm not from the financial sector. Hot money means money that comes in, all right, for a short period of time, maybe less than 1 year, perhaps. I'm not sure what's the definition of time frame here. Maybe I'll take it for 1 year. Now, and then money that's gone for maximum return. And if that is the definition, then money will keep on moving from borders to borders, right? And it doesn't matter whether it's ECG, ESG, or whatever it is, right? And a lot of this money comes, I reckon, from pension funds. These are all excess funds floating around from wealthy individuals, right? And all kinds of, from corporations, they've got tons of money like Apple and so on, right? And of course, when they ask for good returns, high returns, this will happen. This is bound to happen. Now, going back to patient capital, what is meant by patient capital? Does it mean putting money into real investment? Okay, is that what it is, or is it beyond 3 years that you consider it as patient capital? Yeah. Thank you.
Okay, I think that time frame is obviously, as you said, it's relevant to the investor. For some people, 1 year is a long-term investment. For some people, it's about their retirement, and therefore it's 20, 30, 40, whatever years it might be. Any thoughts on the panel on that in terms of the question around what actually patient capital means?
Yeah, I thought you had a very good operational definition of hot money, actually. I thought that was a very good first effort. A star. But I think you're right. It is very short term. It's about essentially identifying opportunities and then rotating out of those opportunities. So maybe I can talk about the type of manager who engages in that, and then identify the type of asset owner who makes use of that type of asset manager. I guess this would typically be in the realm of absolute return strategies, basically hedge funds, etc. Those are the type of strategies that typically have that short-term investment window. Who makes use of hedge funds? Actually, pretty much everybody. High net worth individuals, pension funds. Pension funds may typically have an allocation anywhere between 0 to 10% in hedge funds, for example. So, I think that's how you would think about hot money. Patient money, I think, is everything that goes outside of that. It's about taking a longer-term view. And as we mentioned before in the discussion, I think ESG and Islamic finance does actually emphasize that long-term investing, perhaps accentuates it a little bit more than a non-ESG focused investment approach.
Rushdi, please.
I guess another way of looking at this, sir, is the following. Hot money, from my perspective, is linked to arbitrage opportunities. There is price differentials, and through computer-generated algos, you capture the difference by throwing a ton of money. A result of that has been flash crashes, if you're familiar with that, in 2010. So it's an arbitrage capture opportunity, short-term money. But then you're looking also at speculators. You're talking about hedge funds. You're looking at speculators. In other words, is hot money equivalent to casino capitalism? Casino capitalism, honestly, doesn't have a building of a foundation prospect. Who does it benefit? It benefits the intermediaries involved in executing the trade. Does it add value to building a responsible finance? Probably not. But as I said, are we going to try to look at the causes? Are we trying to cure it? Or are we trying to contain it? The best I think we'll do for the next decade is just try to understand the cause and try to contain, because you're not going to cure it.
Okay. Any more thoughts along that, Tom? Okay. Okay. Yeah. Another question, please, lady at the front. Thank you.
Good morning, Margie from Thoughts in Gear. This is a question for Rushdi, if that's okay. On the topic of access to risk capital, in your opinion, what would be quicker for us to move the needle? Sorry. Do we continue to innovate and grow social financing vehicles, or should we work to pivot mainstream asset funds to new dimensions of scrutiny and evaluation? Thank you.
Thank you. I think it's a great question. My simplified answer is, let's look at what Kickstarter started many years ago, which is crowdfunding. There's 4 types of crowdfunding: equity-based, donation-based, reward-based, and debt-based. Sukuk can apply to debt-based crowdfunding. Crowdfunding and crowdsourcing is what we call people's capitalism. It's basically providing that risk capital to entrepreneurs that VCs, which only exist in theory in Islamic finance, have not been able to address. So when you're talking about disruption, Islamic finance is ripe and right for disruption with crowdfunding, peer-to-peer lending. You watch this space in the next couple of years, that you're going to see the revival and renaissance of Islamic finance by way of inclusion with these type of platforms.
That's a very interesting point, because you're talking about very much also the technology driving it. So this isn't just about their whole underlying principles, but also the technology that drives it. Do you want to add something to that, please?
Yeah, I think I agree with Rushdi that the revolution taking place in the digital fintech area is going to be very positive for Islamic finance. As people who are familiar with the computing, they say most of these computers, Windows-based, says Intel Inside. So I see that in the future, when you have all these fintech companies and the crowdfunding, you might see Islamic finance inside. It may not call Islamic finance, but it will be practicing the principles of Islamic finance through these. And as I said, don't be surprised if it's start coming back with these fintech and say Islamic finance inside.
Okay, thank you. Okay, do we have another question? We have a question right at the back here, gentleman there.
Hello, my name is Adrian from Liberty Insurance. I have 2 questions. One is, one of the speakers mentioned governmental support for responsible finance. My question is, without that governmental support and fundamental change on how governments view and even criminalize irresponsible finance decisions, what is our confidence that there will be meaningful change in the market? As we all know, the people responsible for the 2000 crash, the 2008 crash are still walking around. There's no criminalization of those irresponsible decisions. So how confident are we that that can change? And number 2, with ESG, we started to quantify and price in environmental, social, and governance issues. One of the keynote speakers mentioned even pricing water and air. What is our feeling that this may not be the next area of speculation? And that would cause additional instability in the financial markets. Thank you.
Gosh, 2 good questions there. Rushdi,
Your second question first. ESG at one level will become an asset class, a thematic asset class. It'll be no different than BDS, boycott, divestment, sanctions, okay? And if there's opportunity to make money because of arbitrage, mispricing, money will flow. A hedge fund concept someone will pitch it to a high net worth, and before you have it, ESG, which has certain implications in our mind, becomes maybe hot money oriented. That's a scenario. I'm not saying that's going to be what's going to happen, but that's a scenario. With respect to government support, I go back to the example that I used in my introduction, what the government of Malaysia has done. You need to jumpstart what we call goose something. You've got to start it somewhere, because the government, in its wisdom of its 5-year, 10-year plan, I use the word wisdom in quotes, basically says that, okay, we will seed it. If the result of this seeding produces returns and they are access to a counterpart benchmark, then that basically acts as an inducement for the private sector also to come in. If you look at many of the Islamic funds and you look at, are they seeded? They seeded nominally. You don't have institutional money seeding Islamic funds. It's high net worth money. So the government at one level, if it wants the asset class to rise, it needs to say, okay, we should seed it. It'll get press play, and hopefully it gets some returns.
One perspective around that is, how reactionary is often. Do we need to see that more, kind of a more proactive forethought going forward in terms of what the horizon looks like, as opposed to quite often it's a reaction to the market or a reaction to, you talked the question about criminalization, about there are people still walking around who caused this crash. We see a lot of reactions going on. Do you think there's more change needed? The focus of ESG offers that opportunity.
The reaction is also become sort of hot money time oriented. That's the best way.
Patient hot money.
Yeah, patient hot money reaction. The thing about Wall Street is it's got a very short-term memory. You've got slaps on the wrist, and you're willing to make $1 billion, and you're willing to pay a fine of $800 million, and it's a $200 million profit. Unfortunately, that's the mindset of some of these rogue personalities and rogue institutions. If it's making money, everyone jumps on that bandwagon. This is the price that we're prepared to pay to have this excess money come into our pockets. I don't know how to address this because I'm not the appropriate person, but this is a mindset that does exist.
It comes back to this behavioral aspect we were talking about earlier on. So Azmi, you wanted to add?
First question about these government support.
Please, yes.
Yeah, on the government support. I think my answer will be in terms of giving an analogy. You see, a lot of people ask in our work when we help IDB member countries, the 56 member countries, some of them are interested to implement Islamic finance. So they ask us a question, since especially I come from Malaysia. So they ask, why is Malaysia successful in implementing Islamic finance versus some other countries are not that successful? I think my answer would be government support, government support, government support. Okay, why I say that is because you see Central Bank is giving full support. Securities Commission, the Capital Market Authority is giving full support. Ministry of Finance is giving full support. And many other in terms of the banks itself, the higher education and so on. So you get a comprehensive range of support to develop the industry and to push the industry further. And so much so that this has been emulated by many other countries because of that. And what we're seeing now is our next door neighbor, Indonesia. Indonesians used to say that Islamic finance is developed from bottom up. So it doesn't come from top down, it's more bottom up. But more recently, they established a national committee chaired by the president of Indonesia himself. Why they did that? Because they learned from Malaysia. They see that Malaysia is successful because you have the comprehensive range of support. So now what they're doing now is that they have a national committee chaired by the president, and where all the ministers are there to support the development of Islamic finance. Of course, this will be a challenge to Malaysia in a sense. But you see that the success of Malaysia, of government support, is now being emulated by many other countries. So what we can see is that to be successful, government support, and government support. These are the key things.
Correct. I think just giving other examples of other countries, I think I have seen that many countries, the public sector, the public policy makers are not very conducive to the idea of Islamic finance, unless they are fully become aware of the whole issue. And many countries have seen it's demand driven. The public and the consumer and investor wants, and they put a pressure on the government, and government ends up saying that, okay, yes, we need to take care of this thing. And I think, two examples, Saudi Arabia is one example with a lot of bottom up kind of a law, demand driven by the common person and investors. And in Pakistan is another case where although the governments are kind of not very keen, but there's quite a bit growing demand, which is putting pressure on them to become more active. But I think at the end of the day, for any government, it should be a good common sense business. If they see that there's a value in it, why would a government not do it? So I think the main thing is how to sell the idea, how to market the idea to policymakers and make them convinced that this is a better value, and it is pro-growth, it's pro-development, and all the other benefits. Once they bought the idea, then they will support it.
I suppose the answer is if you see the government supporting it, you're more likely to see that patient capital come from investors, both institutionally and also the retail, which we covered earlier in terms of the retail investor. And that's about covering that behavioral finance side. Yeah. Please.
Maybe I can address the second question, which I guess was to do with unfettered speculation. I guess the broader point is, do capital markets have a role in this discussion? I think the answer is definitely yes. There obviously are a few concerns. I guess part of your concern was triggered by what we saw in the US with those with acquisition of late drug patents, for example, and the huge price increases that resulted in that. But I think the market does have a role. First of all, if as investors we are buying shares in companies that are expressing ESG values versus those that don't, that definitely is a market-driven force that is positive. We've seen this certainly in developed markets where board of companies, company boards have obviously changed their behavior, I think, to incorporate ESG values into their strategic thinking. I think that's obviously a very positive change. I think, but there have been other examples. And I think this goes back to, I think the original, your question arose from one of George's comments earlier about public goods and water and air, for example. So the debate is, do markets have a role when it comes to public goods? A great example of where it's had a very positive role perhaps would be carbon credits, right? You have a public good, which is the amount of CO2 that can be created, and market-based mechanisms allow those quotas to be traded. That I think is an example of where the market-based mechanism can actually create a positive social value, but without excessive speculation. But it needs to be done in the right way, I think.
Yeah, thank you. Okay, we've got time for one more question. Gentleman at the front here, please.
Thank you. My name is Muhammad Ahmed Bushra Badawi, Assistant Governor, Central Bank of Sudan. I have, in fact, 2 points. The first one is regarding the issue of hot money and patient capital. I think we all agree that the ultimate objective of both is profit. So the question will be, what made that hot and what made the other patient? I think the factors that behind making this segregation has nothing to do with the ultimate objective. If the patient know that his objective of the making profit is going to be done in the most shortest way, is he going to be patient? I don't think so. This is the first point. So I don't think this sort of argument will lead us to the basic issue of responsible finance. I don't think it's tackling that issue. The second point, I want to talk about the experience of my country, Sudan, in the Islamic finance, to raise the issue raised by Mr. Ramiz regarding the risk-sharing modes of finance and risk-shifting modes of finance. He said that risk-sharing modes of finance can be used to serve the goal of responsible finance. You know that Sudan had a full-fledged Islamic banking system since 1984. And from our practice, yeah, we, at the beginning, we allowed, as regulators in the central bank, we allowed banks to use whatever being accepted by Sharia people as modes of finance. But from the practice, we realized that banks and customers are all prefer to use risk-sharing modes of finance, i.e. murabaha, for the sake of the knowledge of the participants in this gathering who don't know murabaha. Murabaha is a contract of selling contract. The bank is the seller and the customer is the buyer. But in murabaha, when it is done by banks as the mode of finance, the payment will be delayed. That is murabaha finance, mode of finance. We discovered that most of the banks use this mode of finance. And to our astonishment, even customers prefer it. Why? For banks, it's okay because they shift wholly the risk to the customer, i.e. goods are sold to the client, and the bank take whatever sort of guarantees, charges, to use it if the customer failed to pay on the due date. For banks, that is okay because no risk remain on the side of the bank. But for clients, to our astonishment, that they use that mode of finance because they prefer it to the risk-sharing modes of finance, like musharaka, mudaraba, and other modes of finance. Why? They discovered that the risk-sharing modes of finance involve bank involvement in the day-to-day management of their business, i.e. because the bank is like a shareholder. So the bank will be on daily basis or from time to time will be involved in the management of their business, and they thought that this is something which is not preferable, which is not good for them as customers. So they resort to the risk transfer mode of finance, which is murabaha. We as regulators, we try to contain that, to specify a certain percentage of murabaha in the total portfolio of banks. But although we use that for 2 successive years, but we found it is impractical to many reasons. Time, I think, will not be sufficient for me to explain the reasons, but I will leave the issue.
Could we ask perhaps the panel just give some thoughts around that? Because I mean, I think it's a very valid point in terms of understanding then, in terms of Islamic finance, the difference between this short term and what it's about in terms of the patience around the investment side. Any kind of thoughts on that at all? Thank you.
If we take the example of tax jurisdictions, United States, UK, so on and so forth, and hot money is taxed excessively. Will that deter hot money, and will it change its color and complexion to become a little bit more patient capital? I don't know, to be honest with you. But as I said, you're not going to cure it, you're going to try to contain it, and tax measures may be one way of containing it.
Okay, we're going to draw to a close now, so just going to ask perhaps if any of the panelists have any final comments they'd like to leave with us, and then we'll actually have a final poll question. Any just final comments?
Yeah, I mean, just conclude. I think the distinction between hot money and patient money and how to, attract one or the other depends on the structure of the economy. If the structure of economy is over-financialized and the real sector is less and the financial sector is huge, which is happening in many countries because of high leverage, you will attract hot money. But if you develop your economy which is more asset-based and has a real direct finance, the connection between the financing and the real economy is very closely coupled, you will attract less hot money and you will attract more patient capital.
Dr. Azmi.
Yes, 2 points. One is, I think the issue of convergence between Islamic finance and ESG needs to be addressed, in a sense that one, Islamic finance, especially on the fund management side, needs to incorporate both negative and positive screening. So in that way, there can be more ESG type of thing. Secondly, we need to develop more of the Islamic institutional funds, so that it tends to be more long-term capital. Hence, the development of endowment fund, WAC fund, must be supported by government, of course.
Thank you. Hon, please.
Yeah, I'd like to talk about infrastructure because it's a shame we didn't really have time to talk about infrastructure development. It's a high social utility type of investment vehicle, so we should have had some time to talk about it. But I think of this as something that we as a group need to focus on. I see this as 3 phases. The first phase we're in right now is about creating more bankable projects, trying to reduce some of those barriers to create a bigger pool of investment of infrastructure projects that may be investable. The second phase that I see would be the creation of instruments that investors can buy. So phase 1, there's probably only about $1 trillion of assets that can buy that. These would be, some of the people like the ADBs of this world, the World Banks of this world, AIIB, some of the infrastructure funds. The second phase, project bonds, green bonds, Sukuk infrastructure bonds, there's probably a $10 trillion market of investors who could potentially invest in this. So that's something that we should be thinking about, particularly the green component and the Sukuk component to make that happen. I think the third phase is really thinking about creating funds, infrastructure bond funds. So these would capture the vast group of investors out there. That's probably a $100 trillion market. Retail investors, private banks, institutional investors. So that is, I think, the progression we should be thinking about. Infrastructure is a very important high social utility, high social valuable type of investments to think about.
Good points. Yes, that's very good. Thank you. Rushdi, please.
I would look at patient capital and hard capital, especially foreign money coming in, from the following perspective. I would want to look at the lay of the landscape of that particular country. If the lay of the landscape of that particular country is more oriented towards hot money, you're going to have hot money coming in. That's the reality of the situation. And if that particular country in question has stock markets and has products and has very few index funds, has very little pension fund exposure, has very little sovereign wealth fund exposure, that is a potential cause for your hot money in your landscape, and that is also a magnet to bring in hot money in your country.
Excellent, thank you. I think in terms of summing up, that pretty much covered. I don't think I need to kind of repeat anything that's just been said by the 4 panelists, but certainly building value into patient capital is something that's a general consensus picked up with today. I'd like to thank the 4 panelists today, Dr. Zamir, Dr. Azmi, Hon and Rushdi, for making such a useful contribution to this first panel today. And we have a final poll question, I believe, just for everyone to answer. So this is the close of session here. So what is the most important to enable responsible finance to stabilize capital flows? So we've got 3 options here. Develop international frameworks to encourage responsible investment flows, or B, shift focus away from do no harm exclusionary approach to active support for business activities in support of sustainable development, which I know we did cover in the discussion, or restrict free flows of international capital through limited capital controls. So not something we picked up with this time. So if you could perhaps give your answers, just give you a minute or so for that. Okay. Do we have a 1 minute? Here we go. Okay, well that's very promising to see. In terms of nearly half saying the middle one. So certainly that's a very positive, again, view taking forward that we can take away from this. So I'd just like to ask everyone to put their hands together to thank the panelists for this first panel.